Let's start with the basics. What exactly is a tariff? A tariff is a tax imposed by a government on imported goods. The purpose of a tariff can vary. Sometimes it's to protect domestic industries, sometimes it's used as a political tool in trade disputes, and other times it's purely a revenue source. The current hot topic in the United States is the additional tariffs placed on certain imports, especially from countries like China, Mexico, and even Canada. These tariffs, which can range anywhere from 10 to 25% or more, are levied directly on the importer of record, meaning the company bringing the goods into the U.S. Technically, it's the importer who pays these tariffs at the port of entry, but this is where reality and theory split apart. Importers, whether they are retailers, manufacturers, or distributors, rarely just absorb these extra costs out of generosity. Instead, the cost of the tariff gets baked into the price of the product, which then gets passed down the supply chain until it hits the consumer. This means that American businesses and everyday consumers ultimately pay for tariffs, either directly through higher prices at the store or indirectly through reduced product availability, lower quality substitutes, or shifts in the supply chain. To see how this works in real life, we can look at the China tariffs imposed under Section 301 during the Trump administration. Importers initially tried absorbing some of the cost, but that quickly became unsustainable, especially for low-margin businesses like apparel or consumer electronics. Eventually, the tariffs led to price hikes across countless product categories, from washing machines to bicycles. In fact, a 2019 study by the Federal Reserve Bank of New York estimated that the average U.S. household paid an extra $414 per year due to these tariffs. That was just one tariff package. Today's new tariffs will likely compound that cost even further. Importers are faced with unpleasant choices. Importers are faced with unpleasant choices. When prices rise, consumers cut back on spending, switch to cheaper alternatives, or delay purchases altogether. This ripples into reduced retail sales, weaker economic confidence, and ultimately slower economic growth. Facing long-term tariffs, companies scramble to change suppliers, look for new sourcing countries, or restructure manufacturing footprints, a process that takes years and introduces massive instability. Some businesses, especially smaller importers or retailers with thin margins, simply can't survive the new cost structure. They either go out of business or get acquired by larger competitors, leading to further industry consolidation. Higher import costs feed directly into higher consumer prices, fueling inflation. This creates a vicious cycle where wages don't keep up and frustration grows. Businesses forced to cut costs often reduce their workforce, causing additional ripple effects in local economies. European Union. In the EU, tariffs are often factored into the VAT system at the point of sale, meaning consumers directly see the impact of tariffs on their receipts. However, the EU tends to retaliate swiftly with its own tariffs, often targeting politically sensitive U.S. exports like agriculture or whiskey. The EU's approach tends to spread the cost across the entire economy, often diluting the direct price impact on any single product. However, this creates long-term instability for exporters. China. China, in contrast, often uses a mixed strategy. Chinese exporters heavily subsidize their costs to stay competitive in foreign markets, even if it means taking losses on certain exports. This strategy, combined with currency devaluation, helps buffer the domestic economy, but it can't last forever. Eventually, Chinese consumers also pay through weaker purchasing power and slower wage growth. Analysts from the Peterson Institute for International Economics estimate that every 10% increase in tariffs on consumer goods adds roughly 0.4% to core inflation in the U.S. If tariffs escalate further, expect inflation to remain stubbornly high even as the Federal Reserve tries to rein it in. Analysts from the Peterson Institute for International Economics estimate that every 10% increase in tariffs on consumer goods adds roughly 0. Countries like Vietnam, Mexico, and India will become even larger players in global supply chains as companies reroute production to avoid tariffs. This is already happening. U.S. imports from Vietnam rose over 40% between 2018 and 2023, largely due to China tariffs. Politicians often suggest that tariffs will force companies to move production back to the U.S., but this overlooks a harsh reality. Many U.S. factories rely on imported parts, materials, and machinery. Tariffs disrupt those inputs too, making reshoring costly and slow. As price increases become more obvious, expect consumer frustration to boil over, with political consequences. This has happened before. The Smoot-Hawley Tariff Act of 1930 triggered not just trade retaliation, but also contributed to the Great Depression. A popular political talking point is to simply buy American products to avoid tariff costs. But that's a simplistic fantasy. Modern U.S. manufacturing relies heavily on foreign materials like metals, chemicals, and textiles. It also depends on imported machinery and technology, as well as global energy markets including fuel and natural gas. Even a made-in-the-USA washing machine contains foreign steel, electronics, and chemicals. Cutting off those inputs would make the final product far more expensive than a tariffed import. If the U.S. were to fully isolate its supply chains, many products would disappear from shelves during off-seasons. A return to the way things worked in the 1700s and 1800s. In a globally connected consumer culture, this kind of seasonality would cause massive disruption. If the United States were to fully isolate its supply chains, many products would disappear from shelves during off-seasons. A return to the way things worked in the 1700s and 1800s. In a globally connected consumer culture, this kind of seasonality would cause massive disruption. The story of tariffs isn't just about taxes at the border. It's about how those taxes echo through the entire economy, touching every household and every business. If you found this breakdown helpful and want to stay informed on global trade, tariffs, and supply chain shifts, make sure to like this video and subscribe to the channel. We also want to hear from you. Do you think tariffs help or hurt the economy in the long run? Share your thoughts in the comments section below. And finally, if you want to dig deeper, all the sources and data we used for this video are listed in the description.